Now to more challenging news today for all of us. Australians just keep getting poorer. I mean, today the latest inflation figure came out. It was worse than economists had tipped. It was 7.8%. And that's the highest in 32 years. And the Treasurer claimed, well, it's probably as high as it's going to get.
This is very high inflation by historical standards. There's no use pretending otherwise. It's unacceptably high. It's in line with the Treasury forecasts for inflation, and it's almost as high as the Reserve Bank's forecast for inflation as well. Now, this is likely the peak in inflation, but we won't know that for sure until we get the numbers for this March quarter that we're in now.
Let's just tease this out quickly with Sky News Business Editor Ross Greenwood, host of Business Now on Sky weekdays at 4:30. Ross Greenwood, thank you so much for joining me. Is this really the peak? Prices up nearly 8% in the year. Will inflation now fall?
Technically, it should, Andrew, and the reason for that is because if prices have already risen by 8% or so in the past year, the question is those prices have already risen from $1 to $1.08. So, you know, they've got to then go to $16, $18 next year if inflation stays at that level. Now, the point is, how far will inflation fall? The Reserve Bank, the government, Treasury would all like it to fall to between 2 and 3%, but that still means that Australians are paying higher prices for their goods in 12 months' time again. And the reality is that if we have really got problems in terms of our whole structure of our economy, the expectations of wage rises, the price of airfares, the fact that energy prices are going to continue to rise, then there is real pressure for inflation to be higher than what the Reserve Bank would expect it to be. And if that's the case, then the real danger here is that interest rates ultimately end up much higher than anybody anticipated, and that ultimately leads to some question as to whether there's a recession, mild or deep, or indeed some sort of economic downturn.
Well, for now, we already know that there's pressure on the Reserve Bank to lift interest rates, probably more than the market was hoping, expecting a month ago.
Oh, absolutely. And this is the basic of it. The Reserve Bank's got its cash rate at 3.1%. The inflation rate annually is at 7.8%. Now, really what's got to happen is either inflation's got to come down or the interest rates have got to go up. They can't be so far apart for such a long period of time because ultimately that means that, you know, they're behind the curve. They're behind central banks around the rest of the world. Last year, the Reserve Bank, remember, went away from those 0.5% rate rises because it was worried about what it would do to the Australian economy, decided it would try and softly creep the economy towards some sort of a soft landing. But the reality is that with inflation now higher than expected, that there's a real pressure on the Reserve Bank to go hard on interest rates or for longer. And of course, remember that there's around 40% of people with mortgages who are going to come off fixed rate mortgages sometime during this year. They are going to confront a brick wall, and the combination of higher energy prices and also these higher interest rates for many families means that at some point during 2023, there's almost a brick wall or a cliff, if you like, that really the family is going to hit, which could curb their spending, which then affects the overall economy. That's the grave fear of having this inflation higher for longer, and then the Reserve Bank being forced to raise interest rates higher than what they otherwise might have.
I think we'll probably have to wait another month or two to know whether we really are out of the woods. Thank you so much for your time, Ross Greenwood.
Quite okay.